What is up, everybody? Here are the 3 things you need to know when pre-qualifying for a loan. So the 3 things that a lender will look at when they're getting ready to qualify you is your income, your debt to income, and your credit score. And here are the reasons why. So your income will determine how much of a loan you can actually get. With the income, for example, if you make $60,000 a year, my best advice is do as least tax write-offs, if none, as possible. Because for example, if you are doing tax write-offs where you're saying it's $30,000 in write-offs, you're only claiming you really make $30,000, which isn't the truth, but $60,000 to $30,000 is a big difference. And they're looking at that $30,000 because that's your net, that's your take home. The $60,000 is your gross. If you are qualifying or getting ready to qualify for a loan, they're looking at the past 2 years of your W-2s, and they're gonna combine that to give you an average. I would say do as less tax write-offs as possible and to try to claim as much money as you can. Because the more money you claim, it benefits you because the higher loan you can get. Now, when they're looking at your income, what they're gonna do is they're gonna look at your past 2 years of W-2s. They're gonna also look at your current pay stubs, of course, make sure you're working, how much you're making monthly, and bank statements. Now, if you're your own business owner, you need to have the last 2 years of 1099s. If you don't have that, you're not gonna be able to qualify for a loan. The difference is when it comes to a business, that's money like your own business. That's money that you're generating and you have to show for that. When it's a corporation, you're getting a set salary that can be confirmed, or you're showing a set monthly or hourly amount you are getting. So it is very important for your business to have your last 2 years of 1099s. If you don't, you do have to wait, unfortunately. Now back to the corporation point, because that's where majority of people are. They look at your last 2 years of W-2s. They're gonna look at, again, your current pay stubs and your monthly bank statements. Now with your bank statements, a big thing is they wanna see the money you have for the down payment and for the closing costs. So if you're looking at a $300,000 home and you're doing an FHA loan, which I'll go into that into the next video, they're gonna be looking at, can you do that percentage down? Can you pay for the closing costs? And you have to show you have that money in the bank. Otherwise, it's not gonna work. Now, for my viewers who are currently not working, and I mean, if you're working at a job for 5 years and they furloughed you due to the pandemic of COVID, unfortunately, you have to wait till you start working again. The great thing is you can at least be working for 1 month to show the consistent pay stubs, and you can pre-qualify for a loan. It's not like you're gonna ruin your chances. You have to wait a whole another year. You just have to wait 1 month, show the lender your pay stubs, and they can then get into the pre-qualifying process for you to get your loan. The next step is your debt to income. What the debt to income does, it will determine how much you can afford for the mortgage wise. So debt to income is very simple. How much debt you're in compared to how much income you bring home. Quick and easy way to calculate your debt to income is take your monthly gross amount that you actually do. So let's say, for example, $4,000, and let's say you're in debt $2,000, just to make it simple. That right there shows your 50% debt to income. So the higher you are, the higher risk you are. And there's a certain factor where you won't even be able to get a loan if you're in a higher bracket of percentage. So my best thing is stay in a lower percentage. Try, of course, to have as least debt as possible. But if you're in certain debt for certain aspects, make sure you have it in a consistent way where your income can benefit from getting an added mortgage to the current debt you currently have. And if you do have a higher rate for your debt to income, they're gonna ask you for more percentage down so you can meet that level that they're looking for. But that's to show how much of a mortgage you can tax on in the sense of adding on to what you're currently paying monthly for your debt. Last but not least is your credit score. Now the credit score will determine your interest rate on the loan. As you've seen in my last video, you're getting the best interest rates right now, better than it's ever been. How that works is the higher the credit score you have, the lower the interest rate you have. And the lower the credit score you have, the higher the interest rate you have. But I mean, if you're looking at a 2.7 compared to somewhere in the 3s, I mean, it's still good. A quarter of a point, half a point, you're still having a really good interest rate. Now, to be able to even qualify for a loan in general, the lowest any loan looks for, which I'll explain the loans in my next video, the lowest the loans they look for is a 580 credit score. Anything under than that, they might do get to put a higher down payment, but realistically a 580. Now in this market due to COVID, credit scores are more important than ever. Now you're thinking, all right, my credit score, I might have this because of student loans or a medical, but there's so many factors when it comes to doing your credit score. And that's what shows the trust the lender has in you paying it back. It's not only how much debt you're in because of whatever situation that's happened in your life, how many inquiries do you have? Are you paying your bills on time? There are so many factors that create that score, because you can be in quote unquote a lot of debt, but you can still have a higher score because you're hitting all those other factors. So with all this being said, reach out to your realtor or to myself, or get a recommended mortgage broker. I would recommend a great mortgage broker that I have. Your realtor could recommend another great mortgage broker that they have. But speak to a mortgage broker about all of this, because it is the easiest way and the best way to find out what you can pre-qualify for, and it's only into your best of interest. Thank you guys for watching. If you like this video, please give it a big thumbs up. Please share. Sharing is caring. If you would like to work with me personally, there's gonna be a link down in the description where you can set up a consultation for free, where I call you for a 15-minute or however many minutes it is to discuss what you need in this market. Thank you guys again for watching, and I'll see you in the next video.